Good morning and welcome to this Monday, September 21st, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. I can tell you we are going to get off to a rocky start this morning. Currently, futures, we got the Dow Jones futures down 650 points. The NASDAQ down close to 200, 182, 183 last time I looked. S&P 500, 64 points. So this is definitely going to be at least a start of a week that could be somewhat dangerous. And I say that because we are looking at the day after options expired. Typically this week can be very difficult for equities to begin with. And I've spoken quite a bit about the fact that September historically is the worst month of the year. We had a lot of sentiment issues coming into the month that created a lot of this technical selling that we're seeing. And now we have technical issues. There's not much in the way of earnings reports. We do have a few, I shouldn't say that. There are some earnings that maybe will get the market back into gear later in the week. From an economic standpoint, very little out this week. So the market's going to be left to trade on technicals, maybe some of these earnings reports. And, it's not looking that great right now, to be honest, as we look at these futures. But this is really what I've been talking about throughout the latter part of August and into early September with those sentiment issues, the market needing to pull back, needing to sell off, needing to consolidate before a fourth quarter run. And this is not surprising to me at all. I expect it's going to be a little dicey this week. I am planning to use this weakness as an opportunity to build up and continue to build up some inventory of stocks as we head into fourth quarter earnings season or pre-earnings season, which I believe is going to lead us higher, but we'll see. All right, I do want to just mention, let me go in and show you for those of you that maybe are new to Earnings Beats. We do have a free newsletter, Earnings Beats Digest. So no credit card required. Unsubscribe at any time. And all you have to do is just put in your name, email address here, hit that subscribe button, and we will send you our newsletter, which comes out Mondays, Wednesdays, and Fridays. It's normally just about one stock, one industry group. Maybe it's on the S&P 500. One of the things I wrote about in here just a couple of weeks ago at the beginning of the month was the S&P 500 and to the downside, where could we go? And that's when the S&P was up, 3,500 and change. And one of the areas that I was looking at was a key Fibonacci level just below 3,300. And I would say with the weakness today, we're probably going to be there, maybe even a little bit below. So there's some really good information, not just on the market, but then there's some trading opportunities and so forth. So I'd encourage you to sign up for our Earnings Beats Digest if you haven't already. Again, that comes out Monday, Wednesdays, and Friday mornings. Last week, and I just wrote our weekly portfolio report to our members. I do that every Sunday. And we actually had a really good week last week, which was very surprising. Not surprising in the sense, I actually expect our portfolios to do well. I mean, we have leading stocks and leading industry groups. And I think when you look at the since inception returns, you're going to see 3 out of 4 doing really well versus the S&P 500. And honestly, if it wasn't for one really bad quarter right here on the income portfolio where we lost back during the pandemic, we actually took a strategy to be more conservative. So we had a financial, we had a real estate company. Well, those were the groups that got hit the hardest. So most pullbacks, you see more defensive areas do better on a relative basis. But in this case, it actually backfired. Being defensive in the income portfolio actually backfired on us. And so, and it underperformed by probably 10 percentage points. So without that, even our income portfolio would probably be hanging right in there with the S&P, which would be pretty impressive considering it's mostly based on dividends. It's not the high growth that, some of these other portfolios are. So you would think in a market that's been favoring growth for so long, the income portfolio probably would take a backseat, but it's actually done much better than the numbers show. But anyhow, portfolios have done really well. Last week, we saw growth underperform value, and that was the reason I was mostly surprised that our portfolios did as well as they did. The S&P 500 last week finished down about 2/3 of 1%. The model portfolio, aggressive and strong AD portfolio all finished more than 3% higher last week. So they all did really well. You can see on a quarterly basis now, the model portfolio trying to outperform the S&P 500 for the 7th quarter out of the last 8. That's pretty impressive. When many mutual funds can't outperform the S&P 500 on an annual basis, the model portfolio actually is doing almost every quarter. So anyhow, if you're new to Earnings Beats, you want to check out our service, there is a no cost 30-day trial. And I say no cost, it's $7 when you sign up, but we refund it to you. So if you want to learn more, just click on that Join Today button right there. It'll take you to the page, show you a little bit about what you'll get. And check us out for 30 days. If nothing else, look and see what we have in our portfolios, follow what we do, get a sense of how we approach the market. I think you'll, if nothing else, I think you'll take something away that'll help your trading. All right, let's take a look at what happened on Friday. It was not a good day on Friday. You can see the Dow Jones finished down 244 points, right down near that 50-day moving average, closed at 27,657. The 50-day moving average was at 27,472. Actually, we tested, I think, that 50-day moving average early in the day and then maybe came back up a little bit, but still down 244 points. S&P 500 minus 37 points on Friday, down more than 1%. NASDAQ down more than 1%, trading below its 50-day moving average toward the end of last week. I know a lot of technicians are really bothered by that. I'm not nearly as bothered by it. I think when you go straight up, the 50-day goes straight up. So when you finally do have a bout of selling, a lot of times you do go below the 50-day moving average. I actually think eventually we're going to put in a cup. I think that this, and I don't know how far we go down. I think this week is going to probably tell that tale. But I suspect we're going to go a little bit lower than we've been. Probably going to see that on the open. And then we'll see what the market's made of. But I think as we get toward the end, the latter part of this week, I believe the market will begin to rebound. I'm not so sure about the beginning here. Mid caps down a little more than 1%, small caps down 3/5 of 1%. But overall, I believe we're still in an uptrend. We needed a period of basing, selling, consolidation. It's not healthy to go up every single day, every single week. And that's what we were doing, especially on the NASDAQ. From that, going back to the March lows, we didn't really trade below the 20-day for months. So I think this is actually some welcome relief. I don't know. It's kind of like being in the scorching heat and humidity for weeks and weeks and weeks. And then finally you walk outside and it's a nice, cool, no humidity day. It's kind of what the market is experiencing right now. So yes, it's coming down. If you're, buy and hold and you're holding through all this, it's no fun, but it's part of the process if you're in it for a buy and hold. Now, if you're trading, then yeah, I mean, there have been warning signs. I mean, we've been talking about this for the last few weeks. So, building cash, which is what I talked about beginning of September, made sense. And, it's the history of the market tells us we want to be careful in September, regardless of what's going on technically. Historically, it's the only month of the year when the S&P 500 has gone down as much as it's gone up in the last 70 years. There's no other calendar month that's gone down with the frequency that September has. So we shouldn't be surprised. I mean, this is kind of normal. It's also election year. We got a lot of stories out there. When you just take a look, over the weekend of the stuff that's come out. I mean, we've now got the political uncertainty surrounding the death of Supreme Court Justice Ruth Bader Ginsburg. I mean, I don't get into all that stuff, but it's in the media. It's out there. So if you're reading news, you can't help but, at least be aware of what's going on. Also, several global banks apparently overlooked money laundering for 20 years. One of those large banks was JP Morgan. Now, I don't know how much truth is in that, but again, there's your headline. Coronavirus, still out there, talking about the rising cases in Europe. There's uncertainty, and the market is already uncertain. There's already some deterioration in what we've seen throughout September. So all of this leading to, and again, when we look back to March, what did we see? We saw big gap downs. That's where we lost a lot of our points, was at the opening bell. Today, I'm looking at the Dow. Let me see if there's an update. Well, it's come down a little bit. Now it's down 582. Dow's down 582 futures. But still, we're seeing the big drop at the open. I'm more interested in what happens after the open. I mean, do we really see 3 or 4 solid days of selling, where there's a lot of distribution? Or is it this gap down, consolidation, maybe rally into the close, another gap down, and then maybe we have a day of selling, we get another gap down, and we have a day of buying. I mean, if it all kind of nets out and offsets, that's not distribution in my view. So we're going to want to watch that AD line, the accumulation distribution line as well. Anyway, all right, spend a lot of time on that. Let's keep moving. 10-year Treasury yield. Give you an update here. One problem too is that there's simply no money rotating out of the Treasury market right now. I mean, I put the S&P 500 on the bottom of this chart, and you can see that when we have our big moves up in the Treasury yield, that means money's coming out of Treasuries. Normally, that money rotates into equities, and you can see that there. Back at the beginning of August, and really even toward the end of September, or excuse me, end of August, you can see that we had a big month with the yield rising. That means Treasuries are selling. What happened? We had a huge August in the stock market. Now what's happening? You can see that since we topped at the end of August, we're actually moving lower in the yield. That means money's rotating into Treasuries. Every dollar that goes into Treasuries is a dollar that doesn't go into the stock market. And what's going on in the stock market? We're selling off, we're consolidating. Now, one exception on this chart, if you notice, was back in March. Look at that huge move up. You would think, wow, tons of money coming out of Treasuries. Why is the stock market going down? Well, I think it was the fear and panic. I just think cash was being built up. I don't think that's normal market behavior, what we were seeing. And this huge drop in the yields, what does that mean? It means money was flying into Treasuries. So there were tons of profits in Treasuries. I think you saw profit taking, sending the yield up, and the money sat on the sidelines. Nobody wanted to touch the stock market. As I always refer to it, market makers were on vacation. Their job is to provide liquidity. But when the demand is so great and everybody is selling, market makers don't put their capital to work. They just let the market fall. It's what we saw back in 1987. It's what we saw back in March of this year, February, March. When you lose 33% in a month, 35%, whatever it was, that's not rational market behavior. That's pure panic. So anyhow, we kind of stabilized in the yield. And as we stabilized in the yield, and certainly during these periods where we saw rallies in the yield, that's where we made up a lot of ground in the stock market back to the upside. So I'm not sure what's going to happen here in the short term, but right now, as long as we sideways consolidate, I suspect that the S&P 500 will probably do the same. It might move back a little bit. I believe we'll rally back. And I think in the fourth quarter, we're going to see the Treasury yield move back up. Even if it's not a huge move to the upside, I think even just getting back to 0.75, 0.8, maybe breaking out, I think that rotation could lead to another huge move up in the S&P 500. I think that's what's coming. But we got to get through the current period now in order to get there. All right. I talked about the sentiment indicators, and for those of you maybe that are new and haven't been following me or haven't been following the show or my blogs, this was a blog I wrote September 3rd, right at the top of the market. And these were indicators that were saying be extremely careful. Sentiment indicators don't come into play very often, but when they do, you need to pay attention to them. And I'll point that out in just a minute. But the two that I looked at was the VIX, and then the other was the put-call ratio. And I want to show you where these reside right now. So here's the VIX. No, I think in the article, I may have shown the VIX with a 5-year chart. Yeah, 5-year chart. Okay, so what I've done, I've actually shown, this is a 10-year chart. So I've stretched it out. But you can see the 5-day moving average on the VIX back at the beginning of September was starting to turn higher while the price's S&P 500 was going higher. That's problematic. The reason being, I mean, if you look at the correlation down here at the bottom. You see how we're down near -1 almost all the time? That means that when the VIX is going up, the S&P goes down. When the VIX is going down, the S&P goes up. That's just the normal market behavior because the volatility measures fear. And market gets fearful when we sell off. So the VIX rises when the market sells off. So we should see this inverse correlation almost all the time. But when we get the positive correlation, when it actually starts moving in the same direction, and you've got the S&P 500 going up, but the market gets more fearful. See, as the market's going up here, see how the VIX is coming down? Then we get this one drop and we get one spike in the VIX, and then the market goes up and the VIX comes back down. Well, what we saw was a period of time where the S&P kept going up and the volatility index started rising. So that just tells us that the market's getting more nervous as prices are going up. That's unusual. Look back, last 10 years, we've rarely seen us move even into positive territory. Now, what I said at the beginning of September was this was the highest level we'd seen in 5 years. It actually is highest in 10 years. I could go back further. Maybe it's the highest level ever. But that's just telling us the market was getting very fearful, even though the S&P 500 was rising. And so if the market starts to just get a little crack in the foundation and it's fearful, this is what you're going to see. You're going to see that selling that we've seen. You're going to see this 10% sell-off and correction. More than that, maybe. This week, I think, we'll have to see what happens. But I wouldn't be surprised to see the market weak this week. So that was a problem, and it's continued to be a problem, and just, we need to be aware of that. The good news is when you go up and you see this positive correlation, almost every single time you come shooting straight back down, because the normal relationship is an inverse relationship, and you can see that taking place again now. So as we were moving lower, we saw the VIX actually moving up. Now we're seeing the 5-day moving average starting to move down. And actually, I think this is actually a bullish sign to me that the market could begin to sell off and the VIX wasn't going straight up through the roof. So I expect what's going to happen is that we're going to begin to rally again in October. And when we do, we're going to see the VIX fall back to a new low. We're going to see this correlation go back to -1 where it belongs. And then the market will be back to normal. Right now, I think it's still a little jittery, and that could create some problems this week. Put call ratio. When you're in the middle of this zone, I'm going to say from about 0.55 up to about 0.7 or maybe 0.75. When you're in this zone, sentiment isn't really a problem, and I don't even really pay attention. It's when we start getting these extremes to the upside, this is telling us a lot of puts are being traded. It's puts divided by calls. So as this gets higher, you're having more puts relative to calls. And it's a 5-day moving average. So this is actually smoothing it out. If I just did a daily, first of all, it'd be all over the place. It'd be hard to read it. But you would be seeing some individual days. I think the highest day ever was like 1.35. So 1.35 puts being traded for every call. Normally, I would say the average is probably somewhere down around 0.6, 0.65. So about 2 puts for every 3 calls. When you get to 1.35, you got about 4 puts for every 3 calls. So it's about double. Anyhow, when you see these high readings, you pretty much are marking. You see these tops, see that top right with the market bottom. See this top right at the market bottom. See this top right at near the market bottom, not quite. You go back over here, 2011, you see these tops, the panic that came in right at the bottom. I don't make this stuff up. This is just market action 101. This is what happens. Everybody panics and everybody, jumps into puts. It's like, the market's going down. It can't do anything but go down. Everybody jumps in and then the market goes back up. Well, the flip side, and I have to say, complacency is a little bit more difficult. I find panic marks bottoms almost every time. Complacency sometimes, I've seen times like, here, a lot of calls being bought. I mean, maybe we pulled back a little bit, but not much. When I see this, I'm not looking for necessarily a major top. It might just be a little consolidation for a period of time. When I see the up high, I'm looking for major market bottoms. Here, it's a little bit more difficult, if you will. I do think when you get a lot of crazy readings for an extended period of time, you look here with all of this action pretty low. You look here, with, again, this is telling us that way, way, way more calls are being bought than puts. And so the market is incredibly bullish when you see all of these readings. They marked some pretty significant tops right there. These maybe not, well, this one marked a pretty good top. This one, like I said, not much. This one, yeah, I mean, we went down a little bit, not a lot. Here we had, this is kind of similar, a lot of pretty big moves. And you can see the market was getting very complacent back as we opened 2011. And 2011 was not a particularly good year. We had actually pulled back. It was later in the year. So it wasn't like it made an immediate call. But the market, was very, very complacent. And that's what happens after the market runs up for a long period of time. We saw it again here after a huge move up. We saw it here after a huge move up. Psychology in the market just goes from one side to the other. It's almost like a seesaw. If you're giving away my age now, anybody on here young probably may not even know what a seesaw is. But, it's just this back and forth. The market gets really bearish, and then all of a sudden you watch. Now that the market's selling off today, you're going to probably start to see this put-call ratio start to move back up again, which is a good thing for the market. We want folks to start buying more puts. When they get really excited that the market's going to keep going down, 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 that's when the market will turn right back up. So we want to watch that. Anyhow, let's keep moving. All right, so I wanted to talk a little bit about consumer discretionary. So first, I'm going to show you on a relative basis, technology. So here's technology, and you can see, nice uptrend. Yes, we've been pulling back, but it's okay. We've done that plenty of times before. Here we pulled back for probably about 5 weeks back in April, May of 2019. It happens, but the overall trend is still to the upside, which I like. But I want to show you consumer discretionary because this group since March, if you think that we're going into another bear market, I mean, feel free, and we can, debate it all you want. But to me, money would not be rotating into consumer discretionary like this. If the consumer gets weak in a recession, in a bear market, consumer spending goes way down. What is this telling us? Consumer discretionary relative to the S&P 500. It's going straight up. I mean, yeah, it's pulled back here in September, but my gosh, it's had such a huge run on a relative basis. I mean, here's your absolute move. 87.5 in March to over 150. Now, again, got to put everything in perspective. We were at 130 before we took this dip. But if we just eliminated, if we could somehow just block all of this off the chart, I mean, what we've been doing really is just continuing to move higher. We're getting a little pullback like we saw, a couple of other times here in this move. But I think that, the virus hit, we shut things down. Consumer discretionary stocks got hammered. But I think this more than anything else tells us we're going to go right back to a strong economy. We are going back to a strong economy. And so I think this pullback that we see is going to set up some opportunities in consumer discretionary. So having said that, what I thought I'd do is look through the industry groups and just walk you through these industry groups, because if we sell off this week, I believe, and we'll have to watch this, I believe we're going to see money rotating, if not this week, then probably next week. I think you're going to see money rotating into some key areas of consumer discretionary. So I want to look for the leaders. Now, hotels have been improving, no doubt about it. But is this a leader? Weekly PPO still well below zero. We had to move up, had a little dead cat relative bounce here, pulled back. I mean, we're kind of consolidating, which is nice. I don't look at this as a leader, though. I look at it as strengthening, which is good for the market, but I don't look at it as a leader. Toys a little bit more of a leader. Certainly, we're got the PPO above zero, trending higher, starting to turn back up again. So I like that. I'm going to watch toys. Restaurants have actually gone positive and took out this prior high. I mean, we had this lower low, lower high on a relative basis that was going from the top in August of last year to the bottom almost a year later. And now it looks to me like we're starting to trend higher. PPO getting ready to turn positive. If we were getting ready for another big bout, closing down restaurants, I don't think we'd be seeing this relative strength. So this is an improving group. I wouldn't say it's a leader, but it's certainly an improving group. Specialized consumer services. Well, I'd like to see another, we're moving up, moving back down, moving up. And again, these are relative moves. But we did break out on an absolute basis, which was nice. We've pulled back. I want to see another push to the upside. That would be very bullish. We got the weekly Relative PPO is above 0. Clothing and accessories, not really there yet. PPO getting close to the center line. And we could have said, hey, look at this. Strengthening. What happened? We failed. Oh, strengthening right to the center line. We failed. Here we go again. Strengthening, center line. I don't trust it. I want to see groups with their weekly relative PPOs in positive territory. If they're in negative territory, this to me doesn't necessarily mean that we've got great momentum, relative momentum. It means that we're slowing the horrible momentum. Moving up in relative momentum or moving up in any momentum when you're below the 0 line is not the same as moving up above the 0 line. I see so many technicians, and it's one thing for me that kind of drives me crazy is that someone will look at this and say, oh, momentum has turned up. Well, it's not that it's turned up. It's just that it went so fast to the downside that it's starting to stabilize. This doesn't mean that, we're out of the woods. I mean, look at these last couple. We saw it. We couldn't get through into positive territory. So you want to be careful with clothing accessories. Let's get that breakout. I'm not saying you can't trade this group, but if I'm trading this group, I've already, in the back of my mind, I'm thinking, this is a group that I can't trust. I have to have my stops in play. Not that I wouldn't have my stops in play anyway on any stock, but I want to make sure that if I'm getting into a clothing stock, that I've got a tight stop. Because if that rolls back over again, we're in trouble. Now, home improvement, great area of the market, really strong area. So yes, if some of these stocks get hit, I'll be looking for some leaders. I think going into the fourth quarter, this would be a great group to own. Recreational services, no. Now look at this. Look at the relative PPO. It looks like it's great, right? We just keep going lower and lower. Again, this is not telling us momentum is great. This is telling us momentum fell off, a cliff. And so just the sheer move to the downside, we're not falling nearly as fast as we were. That's what this means. So I would be really careful still with that group. Apparel retailers, pretty, downtrend. Yes, we're improving finally through the 20 week. That's great. Got a lot more work to do. Specialty retailers, I like. I'm just going to pick up the pace here. Travel and tourism, downtrending. I want to stay away. Gambling, downtrending. I mean, yeah, it got hot there in August, but look, it's starting to roll back over. PPO's negative. Home builders, I love. Historically low interest rates, fundamentals are set up, technicals look good. I'm expecting another breakout there. Broadline retail, I know Amazon's getting hit right now. I would be using Amazon any weakness to build a position, to be honest. Broadline retail has been very strong. It simply got up. And again, here we go. Now we're turning down. Does that mean this is bearish? No, it means broadline retail went up so fast relative to the S&P 500, it needs a pause, and we're getting a little bit of that right now. Furnishings, yeah, they're strengthening. PPO, though, still negative. Be careful. We've seen this before. We actually went positive here and turned back down. You want to not only get through, but you want to see a move up. When we do pull back, you want to see another move up and a breakout. That's how I start to feel more confident about these. Footwear, I really like, and we got Nike getting ready to report earnings. Footwear has broken out relative to the S&P. This is a group to watch. Then you've got business training, downtrend, not looking good there. And then the durable household products, not bad. I mean, definitely, we did break above the 20, pulled back, broke above that level, broke above the 50, pulled back, broke out again. We got a key resistance level, relative resistance level here at about 0.083 maybe. We need to get through that, but relative PPO is building and it's above 0, so that's a good thing. Autos, it's Tesla. I mean, there's some other autos as well, but Tesla really leading here. Recreational products. Now, this is a group that's pulled back that I actually think on a relative basis probably is going to set up nicely for the next quarter. So recreational products is a group I'd be interested in. I like the fact that it's pulled back. I think as long as it probably holds around 0.12, 0.1225, that's kind of a level I'd keep an eye on. And then we got the auto parts. Still at a downtrend. It's definitely improved, but I think this is an area you want to be careful. And then we move into the next group. So I just wanted to walk you through, look at some of those areas of the consumer discretionary that you might want to pay attention to this week as the market weakens. Earnings spotlight, I just wanted to bring up Nike. I mean, here's Nike breaking out to a new high on a relative basis. Couple things. Look at the footwear index relative to the S&P. I just showed you that just a couple minutes ago on the weekly chart. This is a daily chart. We've broken out. Nike versus the S&P has broken out. Nike versus footwear has broken out. And footwear on an absolute basis has broken out. So weakness heading into the earnings report, I actually think Nike looks pretty good. I wouldn't be surprised. I mean, you've got great support down around 105. 50-day moving average, you got the double top. You know, even if earnings come out strong and we gap down, and if the market's weak, that could happen this week, I would be watching that 105 area. I think Nike at 105 would be very interesting. All right, let's move on to the 3 you must see and wrap this up. First up, we've got Boeing. And I just wanted to pull up a few charts on the Dow that I just haven't looked at recently. Now with Boeing, you know, we had the huge couple big moves up, but really we're nowhere near this prior high. We were up to 230, pulled back after that down to around 155. I would watch the 155 level. In fact, I'm going to give you an update because it's after 9:30. Let's see where we open here. 158. I would really like to see this hold on Boeing. For those of you maybe that are value seekers and think that, hey, you know, I want to get into a Boeing, I would watch this level pretty closely. I mean, I think if we get down into 155, 153, even where it is currently, you can kind of build a position down to that level. If it fails to hold, I'd get out. Seriously, I mean, if I start seeing 151, 152 print on this stock, I don't want to be part of it. I mean, unless you get a massive reversal off of that. But volume starts building. And the reason I'm very nervous here is that even when we had the huge move up here, I think it was orchestrated. When I say that, what I mean is a lot of this was just gap ups, not really a lot of follow through on these 3 days. You see these candles? Look at the AD line. Didn't really get much of a pop, even though we had this huge run. Barely even budged to the upside, went to new lows. So I think that was an opportunity for folks to get out of Boeing. And so we were getting gap ups. Traders were jumping in. I think institutions were jumping out. Lots of volume, gave them a lot of opportunity to get out. And now look what's been happening. So I think we got to be careful with Boeing. But that price support area is big. If that doesn't hold, I think it could, you know, continue back down, maybe even back to the 120 level to test the May low. 3M. 3M has been improving. Actually, this stock I think looks a lot better. It's been holding its 20-day moving average, and currently it's trading almost right on it. So this would be an interesting level on 3M. Now, personally, I like a lot of other stocks in the market better than 3M. I'm going through these for those who maybe are looking at companies that are a little less volatile than a lot of the stocks that I follow. 3M, I think, fits that category. I think the 20-day all the way down here probably to about 161, 162. So 166 down to that level would make sense to accumulate if you kind of like some of these companies maybe that haven't done or didn't do as well during the pandemic, obviously struggled and have struggled to get back, but it's more of a intermediate to long-term type thing. You just don't want to be in those high growth stocks that are so volatile. I think 3M current price down to 161 makes sense. Now, if the stock were to close below, say 160, you got gap support right here. That would be below the 50-day. It would be below this gap support. That would make me a little nervous. So 3M, I don't want to mislead anyone. It's not going to be a stock I would buy, but I know that there's a group of investors out there that do like these kinds of stocks over the more volatile. Last one I wanted to bring up was IBM. And IBM is in my opinion, a very well-defined range, and it's right at the bottom of it right now. You look at the last 2.5 months, see these failures, 130, see the gap resistance right here, probably coming in at about 128 and change. That 128 and change up to about 130, that's massive resistance right now. I think if IBM takes that out, that'd be very bullish. To the downside, look where the last two lows have come in, right at 120. I think we're in a narrow 120 to 130 range, and here we are, 120.5. Short-term trading, maybe you go down to this gap support. We did get down to about 119 and change here. So maybe give it a little bit of room. But if I see this stock starting to trade below 119, I would be out. I'd be worried, especially if the market is weak, the balance of this week. I wouldn't be surprised to see it if it does break down. It could go all the way down to about 112.5, 113 to challenge the more intermediate. term support. All right, that is it. Let's take a look, see what's going on in the market, then we'll wrap this up. Dow right now down 527, S&P down 55. We are now at 3264, so we're down. You know, when I talked about, I wrote an article, I think it was in Chart Watchers. I said, you know, 3 potential downside target areas on the S&P 500. And my conclusion was that I thought 3,200 to 3,300 is where the S&P 500 is most likely to bounce. Well, we're in that range now with today's move down, 3264. I think that this week is going to be the bottom in the market. Personally, I think we're going to probably begin to see a pre-earnings run up. And I think you're going to see a lot of portfolio managers using this weakness to rotate into the positions they want heading into earnings. So I believe as we get later in this week, seeing where the money is rotating to, and especially if we start to move up next week, where does that money go? I think that's going to be really important for the fourth quarter. All right, that's it for today. Everybody have a great day. I'll be back tomorrow over at Stock Charts for your next Trading Places Live, and I'll be back here at Earnings Beats on Wednesday. Happy trading, everybody.